The latest inflation reading coming in earlier for the month of April, in line with expectations. But our next guest says we'll need to see more of these prints before the Fed starts easing. Joining us now, James McCann, Deputy Chief Economist at Aberdeen. Good to see you, James. So how many more of these prints? How consistent a trend do we need to see before the Fed gets more comfortable with perhaps cutting rates?
Well, I think at least three and maybe more. Certainly the Fed was alarmed by the spike in inflation over Q1, and Chair Powell was very clear that three bad reports make something of a trend. So I think for the Fed, they're going to be looking at least three moderate inflation gains, and honestly, maybe more. I think that rules out the June and the July meetings. It probably puts September as the first point at which they'd be comfortable easing, as long as things go their way on that inflation side.
And James, when do you think we actually get back to the Fed's 2% target? Do you see that as it's something the second half of this year? It's more of a 2025 phenomenon. What's your timeline?
I think it's 2025. I think, actually they might get a bit more progress on bringing that year-on-year rate down over the next few months. But then it's going to be really, really hard to do over the second half of the year. The inflation they got in late 2023 was really soft, and so they need to get even weaker inflation to drag that annual rate lower. So I think they're going to have to wait till 2025. But I don't think they necessarily need to see core inflation fall back to 2%. I think they'd be comfortable doing cuts before then, as long as they think there's progress still going on. And, that's contingent on a few more months of better data.
Well, and James, there was an analysis out from the Cleveland Fed that said in terms of getting back to 2% inflation, that might not even happen until mid-2027. Does that seem likely to you that we could see that kind of a timeline?
It's not impossible. It's not impossible. I think there's a few things that will drive inflation lower though sooner. I think shelter inflation will come in weaker over a number of months. We've been disappointed in the translation of that for some time now, but I think that process is kicking in. I think we continue to see signs of domestic growth slowing, and I think that's feeding through to the labor market and to wages, and I think those dynamics will feed through quite nicely. But it's certainly true. We had a big inflation shock, and sometimes inflation proves persistent, and it could take us a while to see some of those lagged and feed through effects coming through from that initial inflation shock. So, certainly there are inflation risks, but I do think we'll see pretty decent progress, and I suspect we'll get there before 2027. That would be really bad news for the Fed if it were to, see an overshoot on that type of time horizon.
James, I'm just interested to get your take on the consumer. How generally healthy, resilient you think the consumer looks, James? We still, obviously tailwinds, low unemployment, decent wage gains. How are you thinking through it?
I think the consumer looks in decent shape. I think certainly consumer spending has slowed from the really boomy rates that we saw over the second half of last year. And in some ways, that's probably a healthy thing. The fears were there that was driving a degree of overheating or driving a no landing style scenario for the US economy. But if we look at consumer fundamentals, real incomes are growing at moderate pace, which looks pretty healthy. The labor market still looks pretty solid. Yes, they're not saving a great deal, but their balance sheets in general look pretty reasonable. So I think all the fundamentals are there for, slower but still very respectable consumer spending growth, about 2%. And, that's a really strong engine of activity in the US economy, and that should keep things rolling on, pretty nicely, we think.
All right, James, thanks for joining us today. Appreciate it.
Thank you.